Project Planning and Control, PPNC. Planning and Baseline Architecture. Course 2, Module 3. Module 3, Budget Execution. Module 3 covers the mechanics of budget execution, from the four-step transaction flow through obligation management, cost carryover, WBS base funds control, the Anti-Deficiency Act, and monthly cost plan analysis. Module 3 answers, how does the budget you built in Module 2 become a live execution tracking tool? The monthly cost phasing plan is the connection between formulation and execution, and understanding how to read it is the practical payoff. By the end of Module 3, the analyst should be able to review a monthly cost plan for any program, identify the 4 patterns front-loaded, back-loaded, straight-lined, steep ramps, and explain what each might indicate about the program. Budget execution is where analysis meets reality. The data is live, the variances are real, and the decisions matter. This is the environment in which PPNC analysts work every month for the life of the program. By the end of this module, learners will be able to assess whether a program's planning products are complete, integrated, and ready for implementation. WBS structure and the 100% rule, cost estimating types and BOEs, scheduled baseline development, EVM planning setup, integrated baseline review, risk management and UFE, the joint confidence level, and contract management for PPNC. This module focuses on budget execution and how appropriated funds are managed once they reach an agency. Participants will learn the full execution process, from commitment and obligation through final disbursement, and why effective fund management is critical to program success. The module also covers cost carryover, funding limits, tracking funds through the work breakdown structure, and key compliance requirements such as the Anti-Deficiency Act. In addition, learners will develop the ability to analyze monthly cost phasing plans, identify warning signs and execution data, and take corrective action when actual performance begins to diverge from a plan. Execution is the final phase of PPB, the phase in which appropriated funds are applied to program activities, and performance is measured against the plans developed in the planning, programming, and budgeting phases. The PPB diagram here connects to the Module 2 framework, showing exactly where execution sits in the annual cycle. The February/March passback from OMB is the event that triggers the execution planning that Module 3 covers. Execution is not a standalone phase. It feeds back into planning and programming through the performance data it generates. Poor execution creates problems for future formulation cycles. Good execution builds the credibility needed to support future budget requests. The PPNC analyst who understands all 4 PPB phases can contribute to the full cycle, not just execution tracking. This end-to-end competency is what Bill and I, Rice, are developing in this course. Budget execution encompasses 7 roles: receiving, controlling, distributing, spending, analyzing, replanning, and reporting. Together, these define the full scope of the execution function. Everyone in the organization who handles money, whether through payroll, purchase orders, grants, or contract actions, participates in budget execution. This is not just the CFO's job. Analyzing dollar and replanning dollar are the PP and C-specific roles within execution. These are where the analyst's contribution is most visible and most valuable. Receiving, controlling, distributing, spending, and reporting are largely mechanical. Analysis and replanning require judgment. The full execution role list is the scope of Module 3. Each function has specific mechanics, requirements, and implications for analysis. Understanding all 7 makes you a more complete execution professional. The execution process flows from program authority through commitment and obligation to cost incurrence and disbursement, a traceable chain from legal authorization to payment. These are the steps in budget execution, all of which have monitors and controls, and some of which have annual plans. The monitors and controls are what prevent Anti-Deficiency Act violations. Each step in the execution process has a specific trigger. Purchase request initiates contract action. Commitment reserves funds. Obligation legally binds the government. Cost records work performed. Disbursement makes payment. Missing a step breaks the chain. The step-by-step execution process is also the audit trail. When a budget execution question arises, why was this overspent? Why wasn't this obligated on time? The answer traces back through these steps to the source of the discrepancy. A basic requirement of budget execution is the development of an annual phase spending plan, monthly plans for both obligations and costs that track spending, progress, and compliance with legal and fiscal requirements. Appropriated R&D funds are available for obligation for 2 years. This is the 2-year availability window. It doesn't mean you have 2 years to obligate. It means funds do not expire immediately, providing some flexibility for late-starting contracts. The monthly cost and obligation plan is both a management tool and a compliance document. It demonstrates that the program plans to spend its funds in accordance with appropriation rules and within the available period. Programs that do not develop phased monthly plans cannot analyze execution performance meaningfully. There's no baseline to compare actuals against. The phase plan is the foundation of all execution analysis. This slide introduces the standard format for monthly cost and obligation tracking, the foundational execution analysis tool that compares plan versus actual obligations and costs month by month through the fiscal year. This format is used at NASA installations nationwide. Every analyst reviewing program performance uses this tool in some form. Mastering how to read it, and more importantly, how to identify problems in it, is a core analyst competency. The plan versus actual versus variance structure is deceptively simple. What makes it analytically powerful is knowing what patterns in the variance column indicate about program execution and what actions they should trigger. The monthly cost plan is where all of the Module 1 planning work becomes visible. If the WBS, cost estimates, schedule, and phasing plan were done correctly in planning, the monthly actuals should track reasonably close to the plan. Persistent deviations indicate planning errors. Obligations and costs are planned and tracked separately. Obligations, legal commitments to pay, must precede costs, work performed, and the plan should develop cost requirements first, with obligations as a derived outgrowth. Develop cost requirements first, then derive obligation needs. The cost requirement is what the work actually requires. The obligation plan is the legal mechanism that makes that work payable. Obligation plans can vary significantly from costs, as work is first placed under contract prior to work occurring. A large obligation in month 1 for a multi-year contract will produce costs spread across years. Understanding this lag is essential for execution analysis. At every NASA installation, obligations are planned and tracked. This is the universal baseline. The ability to explain any deviation from plan, whether obligation timing, cost phasing, or the gap between the two, is what distinguishes an effective analyst. Cost carryover, or forward funding, is the difference between total obligations and total cost for a fiscal year. The funds committed but not yet spent, which provide continuity of work during the fiscal year transition. Generally, 1 to 3 months of available cost carryover is acceptable. More than 3 months suggests either excess budget or insufficient execution pace. Too little risks a work stoppage during the appropriations gap period. Higher levels indicate excess budget or lack of progress. This is the flag that attracts oversight attention. Programs with large carryover balances look like they're either over-budgeted or underperforming technically. The carryover calculation is the bridge between fiscal years. It ensures that the gap between September 30th and the receipt of new year funding doesn't interrupt contractor work. Planning it correctly is part of the execution analyst's annual responsibility. Funds control starts with the WBS, distributing the budget through the work breakdown structure to ensure that each responsible organizational unit has a defined, trackable portion of the total program budget. A WBS ensures the ability to distribute funding and measure work performed against the schedule of deliverables. Without WBS-based funds control, spending cannot be attributed to specific work and performance cannot be measured. The financial system allows 7 levels below project level, and projects control and distribute funds among salaries, travel, and procurement. These structural features define how granular control over funds can be and which categories of spending are separately tracked. Bill's pedagogical example is illuminating. A dollar broken into quarters, dimes, nickels, and pennies still totals a dollar. Funds control works the same way. Any amount can be divided into progressively smaller, manageable elements that sum back to the total. 4 execution principles define the compliance framework. Obligate promptly, not just within 2 years. Reduce unobligated balances before requesting new funds. Spend in accordance with appropriation law and understand the Anti-Deficiency Act. Unobligated and uncosted funds rolling through from FY to FY have been a concern over the years. Programs that accumulate large balances create the appearance of poor management and invite external intervention. Funds not obligated in a timely manner can be subject to withdrawal. This is the practical consequence of excessive unobligated balances. The agency, or OMB, can reclaim funds that aren't being used, which creates a budget execution crisis. Utilize unobligated balances first when formulating annual budget needs, as well as applying funds to work. This is step 6 of the 8-step formulation process, reinforced from the execution side. The principle applies in both directions. The Anti-Deficiency Act prohibits 3 forms of unauthorized spending: exceeding available appropriations, exceeding apportionments, and spending for purposes outside the appropriation's intent. Knowing and willful violations result in removal from office and criminal penalties. NASA violated the ADEA in March 2004 to 2006, $30.4 million, and in FY 2005, $1.6 billion. Neither was malicious. Both resulted from control system failures. The lesson: ADEA violations happen when controls are inadequate, not just when people intend to violate the law. Making an obligation for goods or services outside its intended purpose. This is the most nuanced violation. Moving money between appropriation accounts, e.g., from R&D to operations, without proper authorization violates the ADEA even if the total amount is unchanged. Reporting requirements for ADEA violations are significant. The agency head must report immediately to the President and Congress. For any PP&C analyst, understanding the ADEA is both a professional competency and a personal risk management requirement. Cost planning is both a management tool and a government requirement. Programs produce monthly cost phasing plans that are consistent with technical plans and schedules, which are then compared with actual contractor cost incurrence to identify performance variances. Cost performance versus plan will tell us important information about how the project is performing against its technical plans and schedule. This is the analytical link. Cost variance is not just a financial metric. It is a proxy for technical execution. Contractor incurred cost is reported to the responsible agency. The Form 533 and CPR reports are the vehicles. The monthly reporting cadence means you have a new snapshot of execution reality every 30 days. Analyzing cost without reference to the technical plan produces misleading assessments. A program that is 10% under cost, but also 20% behind its technical plan is not performing well. It is just spending money more slowly than anticipated while falling behind on deliverables. Monthly cost phasing plans are built from 6 primary inputs: WBS structure, assumptions, inflation, rates, technical scope, contractor inputs, schedule, and UFE allocation. Understanding how project/work organization can drive cost and make program control easy or impossible This is the WBS Design Insight. A WBS that enables cost tracking makes the execution analyst's job tractable. A WBS that obscures cost drivers makes every analysis more difficult. Assumptions, understanding which assumptions, e.g., inflation, contractor rates, and a host of other input assumptions, are key assumptions documented at formulation time become the comparison baseline for execution analysis. If inflation came in higher than assumed, that's a known driver, not a mystery. The quality of monthly cost phasing plans directly reflects the quality of the planning phase products. Programs that conduct rigorous BOEs, realistic schedules, and careful UFE analysis produce phasing plans that accurately track execution. Programs that didn't will experience persistent, unexplained variances. For additional phasing inputs, technical scope, contractor EVMS/award fee milestone outputs, integrated master schedule, and UFE allocation complete the cost phasing foundation. Understanding how schedules drive costs, recognizing risks. This is the integration point between the IMS and the budget execution plan. When schedule milestones slip, the cost phasing must be updated to reflect the new spending timeline. Contractor input, EVMS output, award fee milestones, etc. The contractor's performance data should inform the government's cost phasing updates. If the contractor's EVM shows they'll miss a milestone, the associated cost should be rephased accordingly. UFE allocation in the phasing plan must match the risk profile. UFE uniformly distributed across 12 months bears no relationship to when risks are likely to materialize. Use the risk analysis from Module 1 to drive the UFE phasing. Monthly cost data supports a wide range of analytical activities, from simple plan/actual variance analysis through rates and trends, to EVM, cost-benefit analysis, audits, and independent reviews. The analysis element within budget execution is a joint effort among project management, financial/program analysts, and financial management analysts. Good execution analysis requires collaboration, not just individual effort. Analysis helps program management make informed decisions. This is the executive purpose statement. The long list of analysis types maps to different decision contexts. Knowing which analysis is appropriate for which decision is the analyst's judgment call. The full range of analyses listed here represents a career's worth of skill development. Analysts who master all of them are genuinely rare and genuinely valuable to program management teams. This transition slide moves to the practical analysis of monthly cost plans, introducing a framework for identifying problems in phasing patterns before they lead to execution failures. I will present the 4 problematic cost plan patterns: front-loaded, back-loaded, straight-lined, steep ramps, with both their legitimate and illegitimate causes. The analyst's job is to determine which applies. Cost plan analysis is one of the most concrete and testable PP&C skills. A well-prepared analyst can review a monthly cost phasing plan and identify problems within minutes. This slide sets up that capability. The patterns identified in the next several slides are based on real programs. They're not theoretical. They're the specific shapes that have historically signaled execution problems, budget games, or genuine technical challenges. 2 foundational cost plan questions form the starting point of any execution analysis. Is the plan consistent with scheduled work, and is it supported by available budget? The first question is the integration test. A good cost plan should accurately reflect good technical plans and monthly schedule of deliverables/accomplishment for the year. If the cost plan and the IMS do not tell the same story, one of them is wrong. Budget reductions and management challenges constrain resources. Often, this is the external force that can decouple the cost plan from the technical plan. When the budget is reduced to less than what the technical plan requires, the analyst must identify which work will be deferred. A cost plan that exceeds available budget is immediately actionable. It requires either a budget increase request or a scope reduction. A cost plan that is inconsistent with the technical schedule is more subtle, but equally problematic. A third cost plan consideration: whether prior year unobligated and uncosted balances are reflected in the available funding for the current year, connects the execution analysis back to the Step 6 formulation discipline. Bill's direct statement: cost planning should include all funds available for costing, no matter what fiscal year of appropriation. Prior year balances are real money. Ignoring them in the cost plan produces inflated new year requirements. Cost plans which ignore prior year cost can lead to inflated budget requirements and excess cost carryover across fiscal years. This is the compliance problem. Programs that consistently carry excess balances attract oversight attention and potentially have funds reprogrammed to other priorities. The carryover analysis from slide 150 and the Step 6 discussion connect directly to this slide. The consistent theme is that prior year balances must be incorporated into current year planning, or the program loses credibility in the budget process. Front-loaded cost plans, monthly cost declining from the start to the end of the fiscal year, have both legitimate and problematic causes, and distinguishing between them is the analyst's core judgment call. Project end nearing, declining effort makes sense, and early deliverables, front-loaded because work is actually front-loaded. His problematic cases: unrealistic workforce ramp-down assumptions and budget gamesmanship to justify inflated annual requirements. The data table included in this slide, 400, 500, 600 peak, then declining, is exactly the type of plan you would question. Ask, what technical activities justify a peak in month 3 followed by a steady decline? If there's no answer, it is suspicious. Front-loading can also be a sign that a contractor is trying to get paid before anticipated problems surface. Programs approaching a difficult test campaign or a major integration event are more likely to experience contractor cost pressure in the preceding months. Backloaded plans, costs increasing significantly toward year-end, are the mirror image of front-loading, with legitimate causes, new project startup, and problematic causes, artificial early-year cost reduction to demonstrate budget constraint. The illegitimate backloading case: attempt to meet cost constraints by reducing plan to justify a budget. This is the most common budget game. Show an apparently low early spend to justify the full-year budget request, then execute to the full requirement in Q4. Rapid increase in workforce hiring: unlikely. This is the technical reality check. Workforce doesn't ramp from minimal to peak in a few months. Hiring, onboarding, and reaching full productivity takes time. If the plan assumes otherwise, challenge it. Backloading often creates the end-of-year execution scramble, programs trying to spend their full allocation in the final quarter of the fiscal year. This creates inefficiency, potential ADA issues, and a poor signal to oversight stakeholders. Straight-line cost plans, same dollar amount every month, are appropriate only for true level-of-effort activities, such as workforce support. They're inappropriate for development programs with milestone-driven spending patterns. Bill's calendar reality: all months are not created equal. There will be 4 months each year with 5 weeks of work, and thus a true straight-line plan will never be correct. Even for genuine LOE work, 5-week months should result in higher costs. Know your contractor's accounting calendar. This is the practical instruction. Different contractors use different fiscal calendars. Some use 4-week periods, some use calendar months, some use 13-period years. The plan shape must match the contractor's actual billing structure. A straight-line plan on a development program is often a sign that the analyst filled in equal values because they didn't know the actual technical plan. It's not malicious, but it is analytically useless because every month will show a variance without a meaningful explanation. Steep month-to-month cost transitions have legitimate causes: fixed-price deliverables, major milestones, and illegitimate causes: instant workforce startup/shutdown assumptions, and externally imposed cost constraints that are simply assumed away. It is illegal to ask a contractor to defer incurred costs. If a steep ramp down is achieved by having the contractor delay billing for work already performed, that's not cost management. It is a legal violation. The workforce reality applies here as well. Instant staff up at start of development, unlikely. Instant staff drop off at end of development, also unlikely. Workforce ramps are inherently gradual. Cost plans that assume otherwise should be questioned. Steep ramp assumptions driven by externally imposed cost targets are common. The program is told its budget is X, and the analyst produces a plan showing X spent in a particular shape without validating whether that shape is technically achievable. UFE placement in the monthly cost plan requires judgment. It should be allocated where risks are most likely to materialize, not spread equally or loaded at year-end to hide reserves. Scoundrels will bury that UFE in July, August, or September. Other scoundrels from headquarters might come looking for money towards the end of the year. Late UFE loading is a known giveaway. Reviewers look for exactly this pattern. Available UFE should be allocated using some intelligence. Plan peaks could provide some insight into UFE planning. Periods of high plan spending are also periods of high technical execution risk. UFE should be concentrated near those peaks, not hidden after them. The UFE allocation pattern in the cost plan is actually a statement about the program's risk assessment. A program that loads all its UFE into the last 3 months of the fiscal year is saying, implicitly, that it doesn't expect to encounter significant risk until then. That's rarely credible. The quality and accuracy of project planning is determined by 2 factors: the effort directed toward analysis and assessment, and the qualities of the analyst performing that work. To connect the 2 modules just completed, budget formulation, Module 2, and budget execution analysis, Module 3, are both analytical activities. The quality of the analysis depends directly on the analyst's capabilities. This slide bridges the technical content of Modules 2 and 3 to the analyst development theme that runs through the entire course. Technical knowledge is necessary but not sufficient. The analyst's human qualities determine whether that knowledge produces value. The following slides on a good analyst are the synthesis of what I believe makes PP&C professionals effective. This is the distilled wisdom of more than 80 combined years in the field. 4 foundational analyst qualities: a why mentality, genuine interest in the program, ability to work well with others, and number sense, are the baseline characteristics that enable effective PP&C analysis. People want to put forth a positive picture. Contractors are incentivized to show progress. Engineers are optimists. Asking why and probing deeper is often the only way to find what's really happening. Takes a genuine interest in the program. Identifies with success and issues, acquires basic technical knowledge, concerned with accomplishing objectives. This is not just a nice-to-have. Analysts who do not understand the technical work they're analyzing cannot distinguish between a reasonable variance and an early warning sign. Has a numbers sense, a feel for numbers, can calculate in your head. This is the practical competency that enables quick sanity checks. If a contractor submits a cost estimate that's wildly inconsistent with historical programs, a numbers sense analyst catches it immediately. 4 additional analyst qualities: reliability, communication, timing, and common sense and good judgment define the professional behaviors that determine whether analytical insight actually reaches decision-makers in time to matter. A half analysis an hour before the meeting is better than a complete analysis an hour after it is done. Timing is a professional competency, not a personality trait. It requires knowing the decision calendar and building analysis work backward from it. Demonstrates reliability, can be counted on to put forth best effort, develops a reputation as a good data source. Credibility is cumulative. Every interaction where an analyst provides accurate, complete analysis builds the reputation that earns them a seat at the table. Is a good communicator, can express ideas and conclusions orally and in writing. Say what needs to be said briefly and clearly. My story about the project manager who asked, "What do you want me to do with this?" captures the failure mode. Great analysis that cannot be communicated is analytically worthless. Knowing the big picture, strategic plans, roadmaps, legislation, and congressional operating plans enables analysts to connect monthly cost variances to program-level implications that leadership can act on. Invite yourself to technical meetings, tour contractor facilities. The less you understand, the more likely your analysis is flawed. This is my direct instruction. The business person who stays at their desk and analyzes reports will always miss something. The one who participates in technical meetings will see problems before they appear in the numbers. Know of upcoming major milestones, meetings, reviews. Befriend program executives and analysts, project management, key technical personnel, other providers of data and information. These relationships are the early warning network that data alone can never replicate. The analyst's big picture knowledge is what allows them to contextualize any piece of data. A cost variance that means nothing in isolation becomes significant when you know it is occurring 2 months before a critical design review. The final analyst qualities focus on analysis skills, knowing how to analyze cost data, knowing the players and their biases, communicating effectively, and developing the relationship skills that enable honest data flows. The engineers tend to be optimists. The program analyst adds value by grounding their estimates in realism. This is the PP&C value proposition, not to be adversarial, but to be the professional who introduces discipline and historical context into plans built by people with technical expertise but optimistic assumptions. Don't be afraid to question. It is how things are learned. Improve your oral and written communications. Learn to read people. Be tough but polite. These are the soft skills that determine whether you're asked back. Being right is not enough if you cannot communicate it without alienating the people who need to hear it. Be tough, but polite is my working philosophy in a four-word phrase. The PP&C professional who can deliver uncomfortable truths respectfully and back them up with data will always be in demand. 3 questions test Module 3 learning, explaining the 4 execution steps and the obligation before cost requirement, defining cost carryover and acceptable levels, and diagnosing a straight-line monthly cost plan. Q1 answer must explain both the mechanics, commit, obligate, cost, disperse, and the principle. Obligation must precede cost because the legal commitment to pay must exist before work is incurred as payable. Without the principle, you do not understand why the sequence matters. Q2 must answer all 3 parts. What it is difference between obligations and costs, acceptable level, 1 to 3 months, and what high carryover signals, excess budget or lack of execution progress. Any partial answer is incomplete. Q3 is the most operationally useful. The straight line plan is the most common phasing error, and the first analytical question, is this LOE work? Is the fastest way to determine whether the plan is credible or a placeholder. This is the close of Course 2. You've now covered the full planning architecture from lifecycle gates through WBS, cost estimating, scheduling, EVM setup, IBR, risk, budget formulation, and execution mechanics. The disciplines in this course do not exist independently. The WBS feeds the schedule. The schedule feeds the cost estimate. The cost estimate feeds the JCL, and the JCL determines whether the program earns the right to cut metal. If any link in that chain is weak, the whole thing is compromised. You can now build a WBS that satisfies the 100% rule and connect to cost accounts through the RAM. Select the right cost estimating method for the lifecycle phase and defend the assumptions. Assess whether schedule baseline is credible, resource-loaded, and integrated with cost. Set up the EVM planning structure before Phase C begins. Apply the 8-step PPB budget formulation process. And read a monthly cost plan and identify the 4 phasing problems before they become execution crises. Course 3 is where all of this becomes operational. The monthly control cycle, EVM analysis, schedule and risk assessment, variance analysis, and telling the story are where everything built in courses 1 and 2 gets applied against live program data. That's where the planning disciplines you've mastered either hold up or fall apart. Before you move on, take stock of what you've built. The planning architecture you can now assess: WBS, cost estimate, schedule, EVM setup, IBR, risk register, budget formulation, execution mechanics, is the foundation every subsequent PPNC function rests on. The standard I hold for this material is the same standard the government holds for your program at PDR. You either have a defensible integrated baseline or you do not. There is no partial credit at a standing review board. The Course 2 assessment requires a score of 80% or above. That standard exists because mastery of this material is not optional for the work you'll do in Course 3. If you're not there yet, go back through the modules that weren't clear before moving forward. Course 3, PPNC Analysis and Performance Measurement, begins with the assumption that you can build a credible plan. It then teaches you how to read the data coming off of it, diagnose what's actually happening, and brief leadership on what it means and what to do next. See you there. Course 3, Analysis and Performance Measurement. Now that we've covered planning, budgeting, and execution, we'll turn our attention to program analysis and assessment. This section focuses on how PPNC professionals evaluate performance, interpret cost and schedule data, identify variances and trends, and provide decision-makers with the information they need to keep programs on track.